Hello and welcome to Pest Control Unlocked. I'm Konstantin Schwartz. Earnings week is now well underway. Rollins presented their results this week and also their outlook for the remainder of the year. Ecolab and Rentokil present next week, and I'll be watching those as well. So today, let's work through some of the results that Rollins presented, and we'll give you a view on that. First, some housekeeping notes though. Nothing in this episode is financial advice. I'm not a financial advisor, and I'm not giving you a financial advisor's opinion. If you're making investment decisions, talk to a licensed professional who knows your situation. This show is for educational and entertainment purposes only. Every view here is my own. So here's how the quarter opened. Wall Street wanted $1.09 billion in revenue. Rollins delivered $1.08 billion. That's a miss of $10 million, less than 1%. Normally, that kind of miss moves the stock a couple of points and gets forgotten by the next day. This one took 9% of the share price by the close of the day. So the miss isn't the story. Something else got repriced that day. And I want to spend this episode working out what. Here's where I'll start. Rollins did something admirable this quarter. When residential slowed down, they went searching for the reason, region by region, pest by pest, income band by income band, in and out of digital channel. Jerry Galhoff spent a good chunk of the call describing the hours that went into it. And you could hear that it genuinely bothered him. At the end of all that work, they gave the market a diagnosis. They said fewer people were searching for pest control. That's a specific claim, and it's a comforting one, because if demand just went quiet for a few days, this fixes itself. But I've been in this industry for a while, and I've been talking to other operators. I had my doubts. So I went and checked the data that I could get my hands onto. The diagnosis doesn't hold. And the thing it's hiding is a good deal more serious than a soft spring. I'll walk you through it. Two of my own theories fell apart along the way, and I'll show you both. How I got this wrong is part of how I got to what's left. Let me put the numbers on the table quickly, because they're the setup, not the point. Revenue came in at $1.08 billion, up 7.9%. Organic growth was 5.7% against an internal target of 7 to 8%. Adjusted earnings were 32 cents, where the street wanted 34. And the stock went from 43.47 down to 39.44. Cash is fine, $166 million of free cash flow, conversion above 115%, net debt of about 1 year's earnings, and $117 million spent on 6 acquisitions in the quarter. This is not a company in trouble. Now, here's the number that shapes everything after it. The weakness wasn't spread evenly across the business. Residential grew 3.6% organically. Commercial grew 7.2%. Termite and ancillary grew 8.9%. 2 of the 3 legs hit the target. One came in at half of it. Hold on to that. We'll come back to it twice. The margins are where it starts to sting. Adjusted EBITDA margin fell from 23.1% to 21.9%. That's 120 basis points. 100 of them came out of gross margin. About 70 were people costs, mostly medical, and another 20 was fleet and fuel. But here's the number nobody made enough of. The incremental margin, 6.5 adjusted, 3.0% reported. To see why that matters, put it next to their own scorecard, which they printed on page 10 of the deck. Over the last 3 years, Rollins delivered incremental margins of 25%. Their medium-term target is 30 to 35%. And this year's guide, after the cut, is about 10%. So 6.5% isn't just short of an ambition. It's 1/4 of what this company actually delivered over the last 3 years. And one more thing, and most coverage will skip it. The CFO who delivered this guidance cut is Will Harkins. He took the job on June 15th, 2 weeks before the quarter closed. This was his first earnings call. He is an accountant by background, chief accounting officer at Rollins, and he replaced Ken Krause. So the man cutting the near-term numbers inherited this quarter. And he's out there defending a medium-term target his predecessor set back in May. Here's my take on the quarter itself. Nothing is broken. The cash and the balance sheet say so plainly. What broke was predictability. And predictability is the whole reason anyone paid 39 times earnings for this business. Which brings us to the diagnosis. First, let me give management a fair hearing. Because they earned one, they were unusually open about their reasoning. A lot of teams in that spot would have said far less. The pressure, they said, was in the brands that wait for the customer to call, Orkin above all, plus others that lean on search, digital advertising, and inbound calls. Galhoff said the lead environment got worse as the quarter went on, before turning at the very end of June. Then they ruled things out, one by one. Retention held, and even improved in parts of the business. Pricing held. He said there was no hesitancy from customers on price at all. They looked hard for share loss and couldn't find any. And they tested the channel itself. They moved money around, changed how they bid, tried to manufacture demand. None of it moved the volume, even when they spent more. So what was left? Pest pressure. Mosquito calls significantly down. Residential rodent work off 30 to 50% in places. Carpenter ants down. And Galhoff named mosquito as his bellwether, the pest that tells him what pest pressure is doing. He said the season started very late. All of that led them to the sentence they gave to the market. Fewer people year over year were searching for pest control. Now, here's the useful thing about that claim. It isn't a mood or an impression. It's a claim about the outside world. And the outside world keeps records. So let's take a look. I started with Google Trends. The slide represents monthly US search interest for 4 terms. Pest control near me, exterminator near me, mosquito control, rodent control, and it runs from 2023 through to July of 2026. Flat and unremarkable through 2023 and 2024. Rising through 2025, and then in 2026, it goes more or less vertical. Let's get more granular on this. Here's the second quarter of 2026 against the second quarter of 2025. April through June, complete months. Pest control near me up 157%. Exterminator near me up 172%. Mosquito control up 120%. Rodent control up 115%. Not down, but up. Roughly double or better on every single term. These are the quarters that Rollins says fewer people were looking. Stay with mosquito for a moment, because it's the sharpest version of this. Galhoff chose mosquito. He called it the bellwether, the pest that tells him what's happening in the field. He said mosquito calls were down and the season came late. Mosquito searches in April 2026 were running at about 2.5 times April of 2025. In April, they were already higher than the peak of the previous summer. So Americans were looking for mosquito help more than they ever had. And Orkin's mosquito calls fell. Whatever went wrong this quarter, it wasn't the mosquitoes. One more thing worth pulling out. The month of May. The month Galhoff called miserable. The month he said baffled him. Nationally, it barely registered. It scored 93 against 95 in April and 100 in June. The shortfall in Rollins' numbers doesn't show up in the country's behavior at all. Now, before anyone accuses me of going looking for the answer I wanted, let me show you how I tried to kill this. There are 2 serious objections. The first is that the measuring instrument changed, and it did. There's a real break in this data around the middle of 2025. It shows up in categories that have nothing to do with each other. So something shifted at Google, not in the world. That's why every figure I've given you is April to June, complete months. And I checked the year before as a baseline. Q2 2025 against Q2 2024 was up 62% for pest control near me. So 2026 is unusual even against a year that was already climbing. The second objection is subtler. Google Trends measures share of searches, not the count. So if total searching fell, and it might be falling as people shift to AI assistants, then every term's share rises on its own, without anyone searching more. That is easy to test. You pull unrelated control terms and see whether they all went up too. Dentist near me up 36%. Check engine light up 26%. How to tie a tie up 23%. Locksmith near me up 7%. A denominator effect would lift all of them. These barely moved. So that is not what's happening. Which brings me to the part where I have to tell on myself. My working theory was AI interception. And I liked it. It goes like this. Somebody finds a rodent droppings under the sink. Instead of typing it into Google, they describe it to an AI assistant. They get advice, maybe get pointed to a hardware store. And Orkin's phone never rings. The demand existed. It just got answered somewhere Rollins can't see and can't bid on. That theory explains everything on the table. It explains why spending more didn't buy more volume, because you'd be buying ads against searches that no longer convert. And it explains why nobody found share loss, because no competitor took those customers either. So I built a test that could kill it. If this is about people describing problems, then problem searches should be climbing, even ones unrelated to houses. And house searches with no problem in them should fall flat. Check engine light is about as pure a problem search as it gets, up 26%, right down with the controls. Lawn mowing near me involves no problem at all, up 52%. House cleaning near me, nobody diagnoses a clean house, up 173%. So the theory is dead. It isn't about diagnosis. The split is home and property services against everything else. Plumber up 279%, HVAC repair up 188%, pressure washing, carpet cleaning, handyman, gutter cleaning, all up triple digits or close to it. And pest control sits right in the middle of that group. I can't tell you why. It might be a real boom in home services searching. It might be a Google change that only touched those categories. Nobody outside Google can settle that. And I'm not going to pretend otherwise. Which leaves me one more test. And it's the one that matters most, because search data tells you what people typed, not what's actually moving around inside their walls. For this, I turned to another source. Cities log every rodent complaint a resident phones in. It's a straight count of real reports. No index, no normalization, no break in the middle of the series. It's far and away the cleanest instrument in this episode. I pulled 4 cities and I'm showing you 3. San Francisco came back broken. A third of the months were missing, and readings like 5 complaints in a month against a normal run of 4 or 500, that's a bad file, not a rat exodus. So it's out. Let's start with New York. Second quarter rodent complaints came in at 9,742, down 11.7%. And 2025 was itself down almost 13% on 2024. That's real support for the management account. And when New York was all I had, I thought I'd found something much bigger than this one quarter. I thought rodent demand was in long-term decline, and this whole industry had been calling a decade-long trend of bad seasons. I was ready to build the episode on it. Then I pulled the Chicago data. 12,663 complaints, up 5%. And the preceding 4 second quarters are essentially flat as well. Then Washington, 6,717 against 5,036 a year ago, up 33%, and steady across all 3 months. So it's not a spike. Put the 3 cities together, and rodent complaints rose 3.6% in the second quarter. So New York turns out to be the one city in 3 moving against the other 2, and against the total. And New York happens to run the most aggressive rat program in the country. Waste containers, targeted zones, a full-time director. Falling complaints there might just mean the program is actually working. That's the second theory of mine to die. But look at what's still standing, because this is the one I defend anywhere. Rollins said residential rodent work fell 30 to 50% in places. Rodent complaints across the 3 major cities rose 3.6%. And even in New York, the one city where pressure genuinely did drop, it dropped 12%, not 30 and not 50. That gap doesn't need my search data to be right. It doesn't need any theory about AI. You can accept management's pest pressure explanation in full, and the math still doesn't reach. There are some caveats. 3 cities is 3 cities, and they're all dense urban markets. And 311 complaints come mostly from renters reporting building conditions, not homeowners buying private service. Related people, but not the same people. I'd want Boston and Philadelphia before I called it settled. So let me tell you what I'm actually willing to say. First, pest control search interest rose year over year this quarter. It did not fall. Second, Pest behaved like every other home service. It wasn't singled out. The whole category was climbing, and yet Rollins' residential business went the other way. Third, pest pressure doesn't explain the size of the drop. That's the whole claim, and it's enough, because it takes away the explanation Rollins gave. Now, one thing in their favor, and I want to be fair here, Rollins sees data I can't. Their own impressions, their own clicks, their own call counts. It's entirely possible their impressions really did fall while national search interest rose. But if that's what happened, that isn't a smaller story than mine. It's a bigger one. It means the demand was out there and something stood between it and them. So here's the take. Rollins' residential problem was not fewer people were looking for pest control. Specifically, the next time Rollins talks about residential lead generation, I think they'll stop calling this a drop in search volume and start calling it a conversion problem or a channel problem. And the language is already moving in that direction. The cautionary statement on page 2 of their own deck lists the conversion of leads into revenue as a risk factor. Here's my second call. They will add some disclosure on where leads come from within the next 4 quarters of reporting. If search interest went up rather than down, then the answer to this quarter is somewhere else. And I think it was sitting inside Rollins' own portfolio the whole time. Remember, residential grew 3.6%. That's the blended figure. Underneath it, the brands did wildly different things. For Orkin, search, digital media, inbound calls is what dragged the number down to 3.6%. Home Team sells through home builders and spends almost nothing on digital. It grew double digits. And Fox runs a door-to-door sales force, selling prevention on the doorstep. It grew in the high teens. Same company, same quarter, same consumer, same weather, same pest pressure, more than 10 points apart. And here's why that's so hard to argue with. Rollins ruled out all the other explanations themselves. Retention, fine. Pricing, fine. Share loss, couldn't find any. Service quality never came up. When you've eliminated all of that, what's left is who starts the conversation. 2 things I'll concede right off the bat. Home Team sells through builders, so some of that growth is in the housing cycle, not the channel. And Fox is growing on a base Rollins doesn't disclose, which is almost certainly much smaller than Orkin's. Both fair. Neither one closes a 10-point gap, though. There's one more number in their deck worth surfacing, because it points the same way. They split growth into organic and acquired by service line. Residential was 3.6% organic and 3% acquired. Commercial was 7.2% organic and 1.4% acquired. Termite was 8.9% organic and 1.6% acquired. Look at residential. It added $30 million of revenue this quarter. $16 million of that was organic. $14 million were bought. So nearly half of residential growth comes from acquisition. That's about double the acquisition help in either of the other 2 lines. The segment growing slowest under its own power is the one leaning hardest on the checkbook. And that's not wrong. Buying growth where organic is thin is a reasonable use of capital. But it means residential's reported 6.6% flatters the underlying business more than any other number in the release. And none of the analysts asked about it. Galhoff, to his credit, framed the difference better than I can. Digital, he said, is see a problem, solve a problem. Door-to-door and the builder channel are protect your house before you ever see a bug. One of those models rents its demand from a platform it doesn't control. The other one makes its own. And that leads to an operating failure underneath all of this, which I don't think got enough attention on the call. Rollins staffed for 7 to 8% growth. They delivered 5.7%. Harkins said as much. The cost structure stayed built for stronger outlook they'd carried into peak season. That's not a demand failure. It's a forecasting failure. And it's what turned a revenue miss of under 1% into an incremental margin of 6.5%. Then Galhoff said something I haven't been able to stop thinking about. Nobody asked him for it. He was answering a question about drought. And he said the whole experience has left him more interested in predictive weather models, especially with AI. that they tried forecasting demand years ago, and he wonders whether today's data and computing power could change the answer. He's looking for better forecasting, but follow the logic one step further than he did. Why can't you forecast pest pressure from call volume? Because call volume is a late signal, it's noisy, and it's distorted by whichever channel the customer happened to use. A company that is measuring pest pressure directly as it is happening can forecast the season better instead of guessing at it. This is an argument this show has been making all along, and this quarter, Rollins made it for me. So here's my take. Where your customers come from now matters more than how strong your brand is. Within 4 quarters, Rollins will most likely shift more money towards door-to-door and builder channels, and say so on a call. This segment is thinner than usual, and that's informative in itself. What hurt Rollins this quarter wasn't regulation, but 3 things belong here. The first, nobody regulates discovery. There's no standard for how a search becomes a referral. No disclosure, no appeal. Rollins says it tracks how it shows up in AI answers. And that's a whole new discipline with no agreed way to measure it. And Galhoff flagged that the platforms will start charging for those answers within months. Anyone in this industry who buys leads should be planning for that now, not later. The second, a question that nobody asked. Residential rodent work fell 30 to 50% in places. Every analyst on that call treated it as demand. No one asked whether it might be supply. Rodenticide rules have been tightening at the state level, especially on second-generation anticoagulants. And if those rules limit what an operator can actually do on a rodent call, then part of what management calls soft demand is a supply problem in disguise. I'm raising it as a question, not an answer. But 11 analysts from 11 firms didn't raise it at all. The third, medical cost inflation. 70 basis point on the margin decline. And management says they're hearing the same thing across industries. Every labor-heavy business in this sector carries that exposure, and most of them have far less scale to absorb it than Rollins does. My take here is that AI-mediated discovery shows up as a stated risk factor in a major operator's 10K within 2 filing cycles. So if this quarter is worse than it looks, why isn't the industry more worried? I think it comes down to 2 pieces of reassurance. And I want to test both, because they're doing an enormous amount of work. The first is memory. Galhoff told analysts this took him straight back to the second quarter of 2017. The season never started. It finally hit around the 4th of July, and they came right out of it in Q3. He said he still has the scars. It was vivid and it was sincere, and he could hear the room relax. So I pulled the 2017 annual report. The demand half checks out. Revenue growth by quarter in 2017 ran 6.4% in the first quarter, then 5.4%, then 6.2%, then 7.6%. The second quarter was the weakest of the year and the sharpest slowdown. His memory is accurate, but the rest of it isn't the same at all. In that soft second quarter of 2017, gross margin went up 50 basis points. Incremental gross margin was 62%. Net income grew 12%, and earnings per share grew 14% on revenue growth of 5.4%. Now hold this quarter next to it. Revenue up 7.9%, better than the 2017 quarter everyone remembers as the bad one. Gross margin down 100 basis points. Incremental margins of 6.5%. Adjusted earnings up 6 points. In 2017, Rollins took a weak top line and held its margins. In 2026, it took a better top line and lost them. The comparison works for the weather. It falls apart on the execution. And then there's the recovery itself, which turns out to have a name. On the 1st of August 2017, Rollins bought Northwest Exterminating out of Marietta, Georgia. About 120,000 customers across 5 states. PCT magazine ranked it the 17th largest pest control company in the country. They paid $143.5 million for the company. So the third quarter of 2017 contains 2 months of Northwest, and the fourth quarter contains 3. So how big was Northwest? Rollins never said. Not in the 10K, not in the 10Q, and no pro forma. So I had to work it out. And I can ask you to check my arithmetic here, because there's no one figure in this episode that I built rather than found. Here's the method. The acquisition note discloses the receivables that came with Northwest, $3.6 million. Rollins' own receivables were running at about 21 to 23 days of sales. So apply Rollins' own collection speed to Northwest's book. That roughly points to about 55 to 65 million of annual revenue. And here's the check that makes me comfortable with it. At that revenue, 143.5 million is about 2.5 times sales, which is right where quality pest control businesses traded in 2017. Two different methods, same answer. If anything, it's conservative. Acquired receivables get written down for collectability, which pushes the real figure up. And 120,000 residential customers in the Southeast collect faster than Rollins' overall book, which pushes it up again. Now, one thing to be clear about, that 55 to 65 million is the full year. Only the months after the deal closed land in Rollins' numbers. 2 months in Q3, 3 in Q4. So we're adding roughly 10 million to Q3 and 15 million to Q4, not the whole annual figure. Take that out and look what's left. Third quarter reported 6.2%, without Northwest somewhere between 3.7 and 4.1%. Fourth quarter reported 7.6%, without Northwest between 3.3 and 4%. And the second quarter, the bad one, the one he has scars from, was 5.4%. So the second half of 2017 was weaker than the quarter everyone remembers as a disaster. The recovery Galhoff described, where July came and they were off and running, was in the reported numbers substantially the 17th largest pest control company in America, turning up on the 1st of August. And notice, we've now seen the pattern twice. In 2017, the recovery was bought. In 2026, nearly half of residential growth was bought. Same play, 9 years apart. Two caveats here, though. The 2017 second quarter had small acquisitions of its own, so it's not pure organic either. And none of these are organic figures, because Rollins didn't report organic back then. But Northwest dwarfed every tuck-in they did that year. The direction survives. I just wonder how many of the 11 analysts from those 11 institutions who heard that story on the call spent an afternoon in the 10Q report. Which brings me to the second piece of the reassurance. And this one is my favorite thing in the whole deck. I don't think they meant to put it there. Page 8 is the recession resilience slide. It's there to make one argument. This business absorbs shocks, and it marks the 3 times the company was tested with the numbers underneath. The financial crisis, revenue up 10%, adjusted EBITDA up 14%. The industrial slowdown, revenue up 6%, EBITDA up 9%. COVID, revenue up 12%, EBITDA up 13%. Every single time, profit grew faster than revenue. That's the argument. That's why this stock trades where it does. This quarter, revenue grew 7.9% and adjusted EBITDA grew 2.2%. Rollins built a slide to prove one thing, that when business gets tested, profits grow faster than revenue, and then put it in the same deck as a quarter where it didn't. In fairness, the 3 periods are multi-year and this is a single quarter. So it's a directional comparison, not a strict one. But the direction is the whole point. So my take on both. If the third quarter comes in at or above 5.7 organic, Galhoff's comparison was fair. And I'll say so on this show. If it doesn't, then the comfort the market took from that story was built on a recovery that was bought, not earned. Let me put my calls on the record in one place, so you can bring them back to me. 1. Rollins reframes this as a conversion or channel problem, not a search volume problem. 2. They add lead source disclosure within 4 quarters. 3. Money visibly moves towards door-to-door and builder channels within 4 quarters. 4. AI-mediated discovery becomes a stated 10K risk factor within 2 filing cycles. 5. Third quarter organic comes in at or above 5.7%, or the 2017 comparison doesn't hold. Here's where I land. Something broke this quarter, somewhere between the moment a person went looking for help and the moment a phone rang at Orkin. Rollins has diagnosed that as a demand problem, and the public data doesn't necessarily support that diagnosis. The distinction isn't academic. It's the whole reason I spent time on this. A demand problem waits itself out. That's exactly what the 2017 story is meant to tell you. The season came late and then it came and everything was fine. If that's what this is, Galhoff is right. The market overreacted and this episode ages badly. A distribution problem does not wait itself out. It compounds quietly while you sit there waiting for a season that already arrived. I don't know for certain which one this is, but I know the evidence offered for the first doesn't hold up. I know both pieces of reassurance the market is leaning on are weaker than they sound, and I know nobody on that call asked about the second. For the third quarter, here's what we'll be watching. Organic growth against 2017 comparison, now that you know what's inside it. Whether 10% incremental margins hold as a floor. Also, the new Chief Operating Officer at Orkin North America, Scott Weaver, promoted this quarter to run both residential and commercial, which is a genuine accountability change, not just a cosmetic one. One more thing, Rentokil reports in about a week, and the single most useful missing piece in everything I've just told you is what happened to Terminex's North American residential business in the same quarter. If they slowed too, this is an industry story, and Rollins is right about the consumer. If they didn't, the no share loss claim has a problem. Thank you for listening. Until next time.